Man, what is it with you guys and the markets on Fridays, huh? Hey, I'm just doing a quick update here. I want to go over the market real quick and then actually try to go over what to expect next week because we've got a big exciting week coming up next week. Want to share that with you as well. If you look at the stock market here today, believe it or not, it's a positive week. This is the true definition of volatility. We obviously had a big, strong start to the week. We fell apart at the end of the week, but we're still higher than where we started. So if you were to just look at an Excel spreadsheet of the performance week by week, you're still going to see about a 1% gain for the week. You didn't see the craziness and then the craziness back down there though, right? So this is volatility. Ultimately, the stock market still gained more than it gains in an average week over the long run, right? So wasn't a fun ride, but that's where we're at. Nonetheless, pulling back here, if you look at the NASDAQ, it's doing the same thing, a little bit more aggressive, and the Dow having a really rough time doing the same thing as well, but still positive on the week. So if you're looking for a bright spot, well, that'd be your bright spot. Let's take a look here. You got the jobs report. Remember we talked yesterday, good news is bad news and bad news is bad news. There was no way around that one. It was kind of, we got suckered into it there. Non-farm payrolls, which are the numbers that came out today, grew by 263,000. That's a 52,000 new jobs drop month to month, but really not that bad. It's good news, actually. So remember, all these different companies were talking about how they were going to stop hiring, hiring freeze, hiring pause, all that stuff. Really not anything close to what we thought you would get there. So, all right, no problem. Now, I dug a little bit deeper on this. You got fewer people looking for work. That was a big help. That's the reason why this turned out to be the case. If the economy was really getting that bad, then more people would be looking for work, would they not? Well, that's not the case, which means the Fed isn't doing what they need to do, which means rates are likely going to go higher, which means the market is moving lower because of that. Unemployment rate down 20 basis points. Sorry about that. 3.5%. I look back, lowest in 30 years, right? In other words, it's hard to say the economy is getting weaker based on that data. This could, of course, change. Strong labor stats in general, mainly because of all the things that were shut down during COVID. Healthcare, leisure, and hospitality, right? Cruises, see them, right? All the healthcare stocks in that sector, they're getting better and better there. It's the service sector, right? That's where we stand here. That's the U.S. economy. We're not a manufacturing economy. We're a service-based economy. So it's good to see that those sectors are where the strength is at there, at least compared to during the pandemic then. Our average hourly earnings, something you might see on TV. I don't know if this is interesting to you. I thought I'd just point it out for you. Down 20 basis points, 5% year over year. We have wage growth, but not as fast as we've seen. So that's kind of a good thing if you're looking at inflation, thinking that's going to be one of the reasons that it falls. That's good news for you there. So it's good news, but still bad news overall, and you get the gist of that. Next week, guess what? We've got earnings season starting up there. So actually, this is not my most updated stuff there. So let's go a little bit first. There we go. We got earnings season there, banks, the real big banks, Wells Fargo, Bank of America, Citigroup, and all of them coming out. We got Pepsi, Delta. I put a couple others in there that are coming out to give us an insight into consumer staples, to give us an insight into transportation, to give us an insight into building materials, right? A lot of the bellwether type stocks that we use as a barometer to kind of see how things are going. When you're looking at the banks overall, we've got a couple things to consider here with the banks. We know we're going to look at two things, right? We're first going to be looking at their reserves that they have to have there. There's a couple, Bank of America and Bank of America and JP Morgan are not quite where they need to be. There's a little bit of a shortfall in terms of total reserves. We want to see that that's changed for those two stocks. We're also going to look at asset management or wealth management, however you want to look at that. Mortgage originations, mortgage servicing, and then the final thing was fees, right? Total fees on credit cards. Because what happened? Mortgage originations fell off a cliff. We know we're going to see that there. Asset management fees, those are going to be weaker, right? If the account balance, think about us here at Jazz, we manage $250 million. Well, if that's now $230 million, the fees that we can charge on that are a lot less than up here. So if we were a public company, we maybe would report lower total earnings because the market fell. Imagine that when you're talking, hundreds and hundreds of billions of dollars with these guys. So that's going to hurt. Less money being made from mortgage originations and wealth management. What we want to see, those stocks that will do better are those that can offset that decline by mortgage servicing fees and credit card fees in there, because the consumer is still spending. So very important there. That's what's going to drive the banks next week, is whether they can offset that or not. It's going to be a big prime focus there. We get the CPI numbers coming out here in the States, but also in Europe and China as well. We want to see inflation. We know what the Fed's looking to do. If the inflation numbers are starting to fall again, that's good news for the economy. If the inflation numbers stay the same or tick just an inch higher, like Biden said last time, that means the Fed's still going to go full blast and do what they got to do there. Here's some of the things. There's the slide that I wanted to put there for you there. Bank of America shortfalls there with their capital requirements there. We talked about fees on AUM, mortgage originations. If we can offset that with the fees in mortgage and servicing, there you go. There's the notes I was talking about there. Consumer sentiment. That's coming out as well. Remember, I shared with you yesterday on the closing beat. Consumer sentiment is really in an incredible low end of the bearish range there. Nobody's really optimistic about the economy right now. We're going to find out how that changed. Also, you got the FOMC minutes coming out there. You're likely just going to see that they continue to talk what's known as hawkish. In other words, aggressive, that they're wanting to go after inflation. And if that means raising rates more and more and more, then so be it. They will do it. Or at least they'll say that they're going to do that anyways. So lots of action there. I just wanted to point out that this is, like, if you want to teach someone what volatility is, just go like this. You only show them this week. That is the definition of volatility. We still gain more than the average weekly gain in the market, but boy, we had to hold on to a roller coaster while trying to go through that, without our seatbelts on, I would say as well. Anyways, I just wanted to give you that update. I hope you guys enjoy the rest of your weekend, and we'll be back at it all next week, man. Look forward to it. Thank you for supporting us here and being on the channel. Lots of good things to come, and hey, enjoy.
Hey, wait! Before you go watch one of our other great videos, have you had a chance to see our new FinTips videos? They focus on one topic at a time, covering investing, personal finance, and anything that can quickly help you with your dough. Best of all, we'll keep it real short, because we know time is money.